Hello, and welcome to the Deep Dive, where we cut through the noise to bring you the essential insights you need to truly thrive. Have you ever felt that nudge, that feeling you should have a better handle on your finances, but the sheer wall of information, articles, courses, all that jargon just makes you want to, well, tune out? You are absolutely not alone there. Today, we're tackling something really important, a deep dive into a comprehensive financial literacy course. And get this, for one person, this course took weeks to get through, generating 109 pages of notes. Weeks. But for you, our listener, we've done the heavy lifting. We've distilled it down to the most crucial insights, the surprising bits, and the advice you can actually use. Our mission to shortcut your path to being genuinely financially literate.
Yeah, and what's really compelling here, I think, is that this isn't just about numbers, it's more fundamental. It's about building a real understanding of how money actually works in your life.
Yeah.
It covers, well, everything from the basics, like budgeting, all the way to the complexities of investing. And honestly, it's essential stuff for everyone, no matter where you are financially right now. So, yeah, our aim today is to really pull out that core wisdom, give you those aha moments so you can feel more confident navigating your own financial world.
Okay, let's dive in then. Let's start with something everyone kind of relates to, budgeting. It sounds simple, maybe even a bit boring, but it's truly the bedrock, isn't it? Forget those super complicated spreadsheets for a second. At its core, a budget is just, well, a plan for your money, where it comes from, where it goes.
Exactly. It's really about making conscious decisions,
Mhm.
to avoid those common traps like just spending too much or getting into debt unnecessarily. And a really popular, pretty easy way to think about it is the 50-30-20 rule. Heard of that?
Yeah, I think so. Remind us.
Sure. It suggests you split your after-tax income like this. 50% goes to your absolute needs, like rent, groceries, utilities, getting around. Then 30% is for your wants, things like eating out, entertainment, maybe subscriptions you enjoy but could live without. And the final, really crucial 20%, that's for savings and paying down debt. So your emergency fund, saving for big goals, investments, it all fits in there.
Okay, right. 50, 30, 20. And here's where it gets really practical, I think, for people listening. We saw this example in the course material, someone making $3,000 after tax. They were actually spending 59% on needs, 27% on wants, and only squeezing out about 14% for savings, 14.17% to be exact. So to hit that 20% savings target, they really needed to cut back on the needs category. And the course had some, well, surprisingly simple ways to do that, didn't it? Ways that don't feel like huge sacrifices.
That's a key point. How do you genuinely lower those need costs without feeling totally deprived? I mean, sure, you could make massive changes like moving somewhere cheaper, but that's not always feasible or desirable. The material offers some really clever, sort of low-effort tips. For instance, just picking up the phone, calling your utility company, your cell provider, your internet provider, and just asking for a better deal. Seriously. Often, they'd rather give you a discount to keep you as a customer than lose you completely. It's a negotiation most people just don't try.
That's a great one. And here's another that really jumped out at me. Paying attention to per unit pricing when you're grocery shopping. Sounds so small, right? Like a few cents difference per ounce or per item. But if you actually apply that thinking consistently, especially to things you buy all the time, those little savings, they really add up. We're talking potentially hundreds of dollars over a year. It's a perfect example of how tiny shifts in awareness can make a huge difference.
Absolutely. It's about being mindful. So, moving beyond just the budgeting part, understanding why we save and how to do it effectively is also critical. The course really highlights three main reasons to save. First, and this is not negotiable really, is building an emergency fund. The general advice is aiming for 3 to 6 months worth of your essential living expenses. So going back to that example, if your needs are $1,500 a month, you're looking at saving somewhere between $4,500 and $9,000. And this money isn't for a holiday or a new phone, it's your safety net. For job loss, medical bills, unexpected big repairs, it's money you absolutely do not touch unless it's a genuine, true emergency.
Okay, so emergency fund first. What were the other two?
Right. Second is saving for bigger planned purchases. Things like a down payment on a house, maybe a new car, or funding further education. Things with a specific goal and timeline. And third, which is really about your future self, is saving for investments and ultimately retirement.
Gotcha. And there was a really smart tip in the source material about how to manage saving for those different goals, right? Something about bank accounts.
Yes. This is a great practical takeaway. You can actually create separate savings accounts for each specific goal. So one for your emergency fund, one for a car, one for a house deposit, maybe even one for a big trip. Most banks let you do this online, often for free. You can even nickname them. And then you can set up automatic transfers from your main account or paycheck. It makes tracking your progress so much clearer and honestly, way more motivating.
That makes so much sense. You see the new car fund growing each month.
Exactly. And something else often overlooked, even with basic savings accounts, is interest. It might seem tiny, maybe just 2% or 3% a year these days, but it's literally the bank paying you a small reward for letting them hold your money. You put in $100, and at 3% interest, a year later you'll have $103 without doing anything at all. It's like your first little taste of having money work for you, even in a small way.
Okay, interest. Good point. Now, let's shift gears a bit. Let's talk credit scores. This is something that feels murky, mysterious, but really important. In the US and Canada, they usually run from 300 up to 850. And generally, if you're in the high 700s or into the 800s, that's considered excellent. That score can mean getting approved for loans more easily and, crucially, getting much lower interest rates, saving you a lot of money.
hmm A credit score is basically just a number that predicts how likely you are to pay back borrowed money on time. It's a measure of your financial reliability based on past behavior. What often surprises people, though, is what doesn't affect your score. Things like how much you earn, whether you're employed, or how much you have in savings. None of that directly counts.
Mm.
It's purely about how you've managed the credit you have had access to. So the advice from the source is spot on. Don't be an ostrich. Don't bury your head in the sand. You should absolutely know your score and check it regularly.
Right. So if someone wants to improve their score, what's the number one thing? And maybe what's a big misconception?
Well, the single biggest piece of the puzzle, we're talking 35% of your score, is simply your payment history. Paying your bills consistently on time, every time. That's huge. But here's where it gets interesting and a bit counterintuitive for some. Credit utilization. This accounts for about 30%. Utilization isn't just having credit, it's the percentage of your available credit that you're actually using at any given time.
Okay, and how does that work? Is using more better?
Actually, no. That's the common misconception. Many people think using a lot of their available credit shows they're good at managing it. But lenders see it differently. They actually prefer to see very low utilization. So if you have a credit card with a $10,000 limit, only having a balance of, say, $100 means you're using just 1% of your available credit. That looks really good. It signals that you have access to credit, but you aren't reliant on it. You're seen as lower risk. So yeah, you want credit cards to build that payment history, but the goal is to show you don't need to use much of the limit. Keep those balances low relative to the limit.
That's fascinating. Low utilization is key. Which brings us right to credit cards themselves. Definitely a double-edged sword, as they say. On one hand, they're fantastic tools, right? For building that credit history we just talked about, amazing convenience. And as the course highlighted, especially in the US, the rewards and cash back can be kind of insane, like points that can genuinely pay for entire trips.
Absolutely. The rewards can be very attractive, but that's the shiny side of the coin. The other side is if you're not disciplined, they can become a huge source of debt very, very quickly because of those, well, crazy interest rates,
Hmm.
missed payments, carry a balance, and suddenly you're hit with annual percentage rates APRs that can easily be 20%, 25%, even close to 30% or higher. That kind of interest digs you into a deep financial hole fast. So the absolute key, the golden rule, is to always pay off the full statement balance during the grace period. That's usually about 28 days between when your statement closes and the payment is due. Do that, and you get all the benefits, the convenience, the rewards, the credit building without paying a single cent in interest.
Pay the full balance. Got it. Okay, so beyond the mechanics, the course also talked about our relationship with money, our mindset. There was this fun thing, the money personality quiz.
Yes, that was quite insightful, actually. You answer a few questions about your habits and preferences, and it suggests whether you're primarily a spender, a balancer, a saver, or an investor.
What's the point of knowing that?
Well, it's fascinating because each type highlights not just strengths, but also potential pitfalls. For instance, the source material mentions someone identifying as a balancer, good at day-to-day management, maybe, but also prone to overthinking or stress around financial decisions. This caution, while good in some ways, could potentially lead them to miss out on growth opportunities because they're too hesitant. So knowing your type isn't about putting yourself in a box. It's about understanding your natural tendencies so you can build financial strategies that work with your personality, not against it. It makes reaching goals feel more achievable.
That makes sense, working with your nature. And speaking of goals, the course recommended the SMART framework for setting them, right?
Exactly. SMART goals are specific, measurable, achievable, realistic, and time-bound. It transforms a vague wish like, I want to be rich, into something concrete you can actually work towards. Like, by the time I turn 30, that's time-bound. I want to have saved $100,000. Measurable and specific as a down payment to buy a house. Achievable and realistic, depending on your situation, of course. It gives you a clear target and deadline.
That clarity seems really important.
It is. And the SMART framework helps you categorize goals, too. Short-term goals are usually under a year, like building that initial emergency fund. Medium-term might be 1 to 5 years saving for a car, maybe going back to school. And long-term is typically over 5 years. Retirement planning is the big one here. And each type might need a different approach. Simple saving for short-term, maybe considering some low-risk investments for medium or long-term.
Right. And one other metric mentioned was net worth. How does that fit in?
Net worth. It's a really important snapshot of your overall financial health. It's simply your assets, everything you own that has value, like your house, car, savings, investments, minus your liabilities, everything you owe, like mortgages, student loans, credit card debt. Assets minus liabilities equals net worth. And here's something important. Don't be discouraged if it's negative, especially when you're younger and might have student loans or a mortgage but haven't built up many assets yet. That's actually pretty common. The key thing isn't the number today, but having a plan and seeing that number trend upwards over time, that shows you're building wealth.
Okay, good perspective. Now let's talk about debt and loans. Those words often carry negative weight, don't they? Lots of horror stories out there. But the course suggested a more nuanced view, that loans aren't automatically bad.
Precisely. It's not the tool itself, but how you use it. Loans can actually be incredibly useful, even essential, for building a better future. When used strategically, they allow you to invest in things that can increase your wealth or quality of life significantly. We often call this good debt. Think about a mortgage to buy a home that hopefully appreciates in value over time, or student loans to get an education that increases your earning potential, or maybe a loan to start a business. These are debts taken on with a reasonable expectation of a positive return or significant life improvement.
Okay, so that's good debt. What's the other kind?
The flip side is bad debt. This is borrowing that generally finances consumption or assets that depreciate quickly, and it often comes with high interest rates that actively drain your wealth. Classic examples are high-interest credit card debt used for everyday spending, personal lines of credit for vacations or things that lose value, and definitely those payday loans. Payday loans are particularly dangerous. The course highlighted APR's annual percentage rates ranging from a freaking crazy 300% all the way up to 800%. That kind of debt is incredibly destructive.
Wow, 300 to 800%? That's staggering.
It really is. So, understanding that difference between debt that builds you up versus debt that tears you down is absolutely vital. And remember, lenders are always assessing risk. The higher they perceive the risk of lending to you, the higher the interest rate they'll charge. They look at your income, your job stability, definitely your credit score, your existing debt levels, your debt-to-income ratio. And for some larger loans, like mortgages or car loans, they'll require collateral. That's an asset they can take possession of if you default on the loan, like your house or your car.
Okay, that makes sense. Lenders need security. Now, moving on to a topic maybe we don't love thinking about, but it's crucial,
Okay.
insurance. Apparently, our expert source was genuinely surprised during the course by just how many things can go wrong and how many types of insurance exist to cover them.
Yes, it's true. It might not be the most thrilling topic, but insurance is a fundamental part of being financially literate and secure. The whole idea behind it is managing financial risk. You basically have two choices when facing a potential financial loss. You can try to avoid the risk, like driving carefully and defensively to reduce the chance of an accident, or you can transfer the risk to someone else. And that's what you do when you buy an insurance policy. You pay a company to take on the financial burden if something bad happens.
Right, like with car insurance. If you cause an accident, your liability coverage pays for the damage to the other person's car or their medical bills up to your policy limits. It saves you from potentially having to pay a massive amount yourself. It's a safety net, not a way to, like, profit from bad events.
Exactly. It's protection. And understanding the jargon helps. The premium is what you pay regularly, monthly, yearly, just to keep the insurance policy active. A deductible is the amount you have to pay out of your own pocket for a claim before the insurance company starts paying. And a copay, common in health insurance, is a fixed amount you pay for a specific service, like a doctor's visit, and the insurer covers the rest. But the most crucial thing about insurance, the real takeaway, the best time, the only time you can reliably get it, is before you need it, before you get sick, before the accident, before the fire. Once the event happens, it's too late.
Get it before you need it. Wise words. Okay, let's shift to something maybe a bit more exciting for many, investing in retirement. And there was this fantastic story in the course material that really illustrates the power of compound interest, sometimes called the eighth wonder of the world. Tell us about Miguel and Jasmine.
Yes, this is such a powerful illustration. So you have Miguel. He starts his job and immediately begins saving just $25 a month for retirement, consistently, every single month. Then there's Jasmine. She waits 10 years before she starts saving, but when she does start, she saves double Miguel's amount, $50 a month, and she does this for the next 30 years.
Okay, so Miguel saves less per month but starts way earlier. Jasmine saves more per month but starts later. Who ends up with more?
You'd think Jasmine right. She saved more money each month for 30 years. But surprisingly, no. Miguel, who only ever put in $25 a month but started right away, ended up with $168,000. Jasmine, despite saving $50 a month for 30 years, only ended up with $147,000. It just perfectly highlights the incredible power of time and compounding. Miguel's money had a whole extra decade to grow and earn returns on its returns. Starting early makes a massive difference, even with small amounts.
That's incredible. $25 a month beating $50 a month just because of a head start. It really shows the difference between just saving and actually investing, doesn't it?
Absolutely. Saving is generally about putting money aside safely, keeping it accessible, low risk. Think of your emergency fund in a savings account. Investing is different. It's putting money into assets, things like stocks, bonds, mutual funds, real estate, with the expectation that it will grow significantly over the long term. It involves taking on more risk than saving, but it also offers the potential for much higher returns, which you need to outpace inflation and really build wealth for retirement.
Okay, so if someone's ready to think about investing, the course provided a kind of framework, right? A 5-step plan.
Yes, a really helpful, practical 5-step framework. 1. Get that budget sorted, making sure you're consistently allocating that 20% slice toward savings and investments. 2, build your emergency fund first. Get that 3-6 months of expenses safely tucked away. That's your foundation. 3, set clear, smart financial goals. Know what you're aiming for short, medium, long term, and decide if each goal needs a saving strategy or an investment strategy. 4, diversify your investments. This is crucial. Don't put all your financial eggs in one basket. Spread your money across different types of investments to reduce risk. And 5, regularly review and adjust. Life changes, markets change. Look at your plan periodically, maybe once or twice a year, and make sure it still aligns with your goals and situation.
That seems like a solid roadmap. Budget, emergency fund, goals, diversify, review. Now, there was a word of caution in there, too, from the expert source about jumping into things like the S&P 500 too quickly.
Right. It's easy to get excited about potential returns, like the historical average of around 10% annually from the S&P 500 index. That sounds great. But the caution was, make absolutely sure your foundations are solid first. Master your budgeting. Build that emergency fund. Get a handle on any high-interest debt. Trying to jump into significant investing without those basics locked down. The source compared it to trying to build a house on a shitty foundation. It's just not stable. Get the base right first.
Build on solid ground. Makes sense. Okay, shifting topics again. Unfortunately, we have to talk about scams and fraud. Seems like they're everywhere these days.
It's a growing problem, sadly. And with technology like AI getting better, scams are becoming more sophisticated, harder to spot. The first piece of timeless advice the course reiterated is simply, if it sounds too good to be true, it probably is. There are no guaranteed get-rich-quick schemes that are legitimate. Be skeptical of unbelievable promises.
Okay, skepticism is healthy. What else?
The second big one is protecting your information. Never ever give out your personal identifiable information, your key II, like your social security number, full date of birth, bank account details, unless you initiated the contact and you are absolutely sure who you're dealing with. Scammers are experts at creating a sense of urgency or playing on your emotions, fear, greed, even kindness, to make you act without thinking. If something feels off, if you feel pressured, just stop. Ask more questions. Do your own research. Don't make decisions on the spot.
Right, pause and think. But the source also added an interesting personal note here, didn't they? About not being too scared.
Yes, that was a really interesting point. A personal caveat, acknowledging that while vigilance is crucial, being excessively fearful of scams can also be a problem. It could potentially make you so risk-averse that you miss out on genuinely good, legitimate financial opportunities or advice. So it's about finding that tricky balance, being cautious and informed, but not letting fear paralyze you from making sensible financial moves.
That's a really important nuance, finding the balance. And this idea of careful consideration extends to big life decisions too, like education and career choices.
Absolutely. Think about university or college. It's a massive financial investment for most people. It's crucial to look beyond just the sticker price of tuition. You need to calculate the true cost, including books, fees, accommodation, living expenses, and then weigh that against the realistic potential return on investment. How much is this degree likely to increase your earning potential? And don't forget opportunity cost, especially for postgraduate degrees. That's the income you're not earning because you're studying instead of working. It adds up.
That's a big calculation to make.
It is. And perhaps the most impactful piece of advice the course offered for these huge decisions, honestly, sounds almost too simple. It's just, talk to people. Seriously, reach out to people who have actually graduated from the program you're considering. Talk to people who are actually working in the career field you're interested in. Ask them about their experiences, the real costs, the job market, the day-to-day reality. That simple act of gathering firsthand information, the source said, can save you a lot of money, time, and headache. Just talk to people.
Such simple, powerful advice. Okay, almost there. So let's touch on taxes and banks.
Okay.
When was the last time you, the listener, paid taxes? If you bought anything today, like coffee or groceries, in many places the answer is probably today. Right. Thanks to sales tax. It's kind of wild when you realize we're interacting with the tax system constantly, not just once a year.
Indeed. And it's not just sales tax. There's income tax, which is usually progressive, meaning higher earners pay a higher percentage. There are payroll taxes for things like Social Security and Medicare, property taxes if you own a home, capital gains taxes on investments. It's a whole ecosystem. And understanding just a couple of key terms can really help at tax time. Knowing the difference between a tax deductible and a tax credit. A deductible reduces the amount of your income that is subject to tax. A tax credit directly reduces the amount of tax you actually owe, dollar for dollar. Credits are usually more valuable.
Good distinction. Deductible reduces income, credit reduces tax. Got it. And what about banks? How do they actually make money? It seems like they just hold their cash.
Well, it's a bit more involved than that. It's actually quite clever. When you deposit money into your account, the bank pays you a relatively small amount of interest for letting them use it. But then they take your deposited money, bundle it with others, and lend it out to borrowers for mortgages, car loans, business loans at a much higher interest rate. The difference between the high interest they charge borrowers and the low interest they pay depositors. That's a major way banks make their profit. It's called the interest rate spread.
Ah, the spread. Makes sense. And there are different kinds of banks, too.
Yes, you've got choices. There are the big national banks. You see them everywhere. They offer a full range of services, lots of branches, ATMs, but they often pay lower interest rates on savings. Then you have smaller regional banks or community banks. They might offer more personalized service, maybe slightly better rates, sometimes perks tailored to the local area. You also have nonprofit credit unions. You usually need to be part of a specific group to join, like an employee group or live in a certain area. Because they're nonprofit, they often pass savings back to members through lower loan rates and higher savings rates. And increasingly popular are online banks. Because they don't have the overhead costs of physical branches, they can often offer much lower fees and significantly higher interest rates on savings accounts. The trade-off might be less in-person service, and some people still perceive them differently regarding risk, although most are insured just like traditional banks.
Lots of options. And within those banks, different accounts for different needs.
Exactly. You've got your checking account for everyday spending, paying bills, using a debit card, usually pays little to no interest. Then savings accounts and slightly higher yield money market accounts designed for holding money you don't need immediately but want to keep safe and earn a bit of interest on. Good for emergency funds. And then you have certificates of deposit, or CDs. In Canada, they're often called GICs, Guaranteed Investment Certificates. These typically offer the highest interest rates for savings products, but there's a catch. You have to agree to leave your money untouched for a fixed period, maybe 6 months, 1 year, 5 years. If you withdraw early, you usually face penalties.
So higher interest, but less flexibility with CDS GICs.
Right. And one final really crucial concept that ties a lot of this together is inflation. Inflation is simply the general tendency for prices of goods and services to increase over time, which means the purchasing power of your money decreases. A dollar today buys more than a dollar will buy next year. So if the inflation rate is, say, 3%, but your savings account is only earning 2% interest, you're actually losing 1% of your real purchasing power each year, even though your dollar amount is going up slightly. Inflation is this silent opponent, really. It will sneak up on you if you don't factor it into your long-term financial planning, especially for retirement. Your investments need to outpace inflation just to maintain your standard of living.
Wow. Okay. That really puts it into perspective. We have covered so much ground today, seriously. From the absolute basics of a budget sheet all the way to the kind of mind-bending power of compound interest, demystifying credit, understanding insurance, taxes, banks, and that silent threat of inflation. It's been a real deep dive.
It really has. And I think echoing the course itself may be the most important takeaway for anyone listening is simply becoming aware of what you didn't know before.
Hmm.
Because now you have a clearer roadmap, right? You've got these foundational principles, some really actionable insights that can genuinely start to transform your financial journey starting today.
Absolutely. So, we want to leave you with a final thought to chew on. We've talked about the dual nature of so many financial tools, credit cards being great for rewards, but risky with debt, investing offering growth, but requiring caution. So, think about your own financial life. Where is there an area where applying a little more informed curiosity, maybe sparked by something we discussed today, could unlock a really significant positive change for you? What's the one thing you are going to look into next? Thank you so much for joining us on this deep dive. Keep learning, keep asking those important questions, and we'll see you next time.